What we were trying to do in sort of putting this together was to get a sort of representative sample of the different types of structures across the property industry. So we picked the four most obvious ones: a PLC stroke REIT, a private company, although we asked Cadogan Estates to come, and they're maybe not the world's most typical private company, an institution, in this case it was AXA, and finally private equity, Brockton Capital.
This morning we're using a slightly frivolous format to answer a serious question. What is the best way to develop and invest in real estate? Is it via the listed company REIT route? Is it via an institution, through a private company, or through private equity?
I'd argue that being publicly quoted gives us different avenues to the debt markets than you get if you are a private equity, fixed life, or even private company. I think that we have a culture that is performance orientated, which means that we are not stamp collectors of assets. Okay, we're unemotionally attached. It means that we have competition for capital, and I think that that is a good discipline, and that is one that's certainly instilled in you as a public company. We have rigorous reporting, and to be honest with you, most of that is dealt with by our finance team, so that's great, and it allows the rest of the team, what I call the Galacticos that we've recruited over the last 2 years, to go off and hunt for opportunities and and satisfy our investors' appetite for greed. And so I'm getting very punchy now. I mean, it does come. It is. Some investors obviously will say that it's a good thing to be more transparent. It does come with a cost, though. Being a public company does cost us money in terms of having to conform with those high reporting disclosure requirements that you get as being a public company. Just looking at safety for a moment, we do live in a world whereby we can buy very good long-term income for around about 7%, which looks like a bond. We don't expect any rental growth from it, and we can borrow money at around about 4.5 to 5, and we can do no work and get a nice cash return of around about 9.5, 10%. And I don't have to go up the risk curve at all for that. The other end, the greed. How do I satisfy investor appetite for greed? To be honest with you, today it's for us it's very much risk-adjusted development. Okay, and I touched on it earlier. We stay very close to our customer, whether it's our shareholder or whether or not it's our occupier. So we will do development, okay, which is something that not many people around this, in this room are experiencing at the moment. You can't do it with debt, all right? No matter how good our relationship might be with our banks, and no matter what anybody says, we have we think the world and have a terrific relationship with RBS. But development, which is heavily pre-let, for us is incredibly accretive. But we are talking, before we press a button on a development, we're talking, in the old days it might have been 25, 30% pre-let. We're up at 70. We're up at 70%. We know that our construction costs, which are falling, which is great, not for everybody in this room, but that income, that pre-letting will cover our construction costs. So we're in, if we don't make any more lettings, so risk-adjusted development is for us is extremely accretive.
I think that the four groups represented here this morning are basically, they are who they are, largely as a result of their cost of capital, which I think drives the nature and the structure of how we're all set up. I think that's the key, is the cost of capital. I think some of the advantages of the private equity model are that you're indifferent to both sectors, locations, even timing, and you can be totally objective about where and how you invest. We've invested into the retail park sector. We probably know, to be honest, less than half of what Andrew knows about the sector, but we're coming up the learning curve very, very, very fast. We're aligned with great management team in Pradera, and that's an example of where we can be in the same sector as Andrew, because we like some of the dynamics of that sector. We can also be in some of the same sectors as the Cadogan, because we're doing some prime residential in London, because we like the supply and demand fundamentals there too. So one of the obvious advantages of the private equity model is that you're not hitched to a particular sector. In terms of transparency, there's just a nuance, but I would argue very forcibly that the private equity model is highly transparent if you are an investor in the fund, and that's the key. If you're not an investor, I appreciate that going into a typical private equity website might not throw off a huge amount of information, and I do appreciate that perhaps the industry needs to do a better job of explaining what it does, how it does it, where the capital comes from, and how they achieve the growth, not just in assets, but also in creating jobs and putting capital to work. But as an investor in the fund, I think we have equal or even better transparency than most REITs. We write to our investors every quarter. So every 12 weeks, and we have, call it 35 to 40 investors in our latest fund. Every 12 weeks, we're writing to our investors. Twice a year, there are third-party valuations. We have an annual conference once a year. It lasts for 2 days. And that's just the formal stuff. In addition to that, given the fact we only have, call it 35 investors, we're constantly speaking to them. Our investors can call us 24 hours a day, 7 days a week, and we'll talk to them about absolutely anything. It's their capital, which means it's their assets, and the team is aligned and is invested alongside them, but we talk to them the whole time, and most investors in private equity, I think, would argue that they understand exactly where their capital is going, how it's being managed, how the assets are performing, and how the management team thinks about the market and capital structure and adding value, etc. So I think we're very, very transparent.
What corporate entity you're in really depends on what your shareholders' aims and preferences and investment strategies are. And in our case, our shareholders are family trusts and charitable trusts, and there's several of them. So being in a private company gives us the opportunity to consolidate a variety of ownerships. So we have single ownership over the whole estate and single management. And it came at a time when the estate was putting in place professional management. And that's the time when we're starting to look at driving investment returns. It also provides the opportunity for the family to have involvement, and we always have the head of the family as chairman, and Lord Cadogan's just retired a couple of weeks ago, and his son, Edward's just taken over. But it's not just picture on the wall. They're very involved in the business, and Edward, who's just taken over, has been involved for 12 years, knows what's happening, and is very much involved in the vision and long-term strategy for the organisation. And I think that's important for an estate because of this emotional attachment. I think it's important locally that the family are seen to be there and take an interest and a pride. Their leadership's important, but their engagement's important as well. Private corporate structure, I suppose we would be seeking long-term resilience, and private companies have been around for a while. In fact, when we set this up probably 20 years ago, there were not a lot of options, particularly if we're seeking to protect our shareholding and reserve it. And of course, there's a very well understood governance and tax regime. And although that changes and evolves from time to time, we had a bit of a shock I was talking to Liz Peace about it, we had a bit of a shock in the last budget because we buy in residential property over 2 million, but that aside, generally it's a fairly consistent environment, and that's much needed.
And Rob, for the purposes of this morning, you're deemed to be the institution. You do a bit more than that, but a lot more than that. Why are you what you are?
Well, what institutions bring to the table is different from my colleagues up here, is that we have a range of products, we have stability, and we have size. And having said all that, any investor out there at the moment would have a wide range of choices. AXA probably provide the largest spread of choice that anyone up here today. But on the cost of capital aspect, the point about our clients is that majority do only want long-term, relatively low risk. So we're always going to be having a relatively low cost of capital, and we'll all just be targeting core plus, essentially. Having said that, we have about 130, over 130 institutional clients, and with that, obviously, we can provide a wide range of products, and that can cover anything from life and pension, which is the more traditional side, but more recently, going less traditional, more value add, opportunity, annuity, JVs, debt. So we are providing the full gamut. On top of that, I'm currently working on launching a property authorised investment fund, so that's a PAIF. And if we're successful in that, then that's the property equivalent of a REIT. So we really are covering the full range.
So the first question, and I hope it's clear-cut because I'm going to struggle to count, but we'll see how we get on. Which of the four models you've heard about this morning do you expect to deliver the best returns over the coming years? Is it Andrew's specialist REIT model? Hands in the air.
Oh, thank you very much.
They'd be booing if... Is it David's private equity route? Is it Hugh's private company?
Better than you, Andrew.
Or is it Rob's institution? David, okay, 1-0. Who would you most like to see owning the building next door to you? So different sort of question. Is it David? There's a hand. There's a hand. Is it Rob? Oh, a couple more. Andrew?
That means you live next door to a retail park. Could be good.
Or is it Hugh? Okay.
Well, I think as we always suspected, and this is sort of why our marketplace, why our sector is what it is, it's horses for courses. It's different structures offer different things. And I think actually that's one of the advantages of the property industry, that, you know, there is a place for the quoted sector, there is a place for private property, there is a place for private equity, and of course we need the institutions. So, you know, when it comes to who would you like next door, everybody would love Earl Cadogan's developments next door. They'd like Grosvenor, you know, to develop next door. When it comes to who's going to make more money for you, no doubt that, you know, private equity is going to win, as indeed it won in the vote here. You know, when it comes to sort of serious development, good commercial-oriented but still sort of environmentally sympathetic development, I think we all love the PLCs and the REITs, you know, which is why it's hugely important that we have them, and indeed why REIT status was so important 4 or 5 years ago, in order to make sure we kept a healthy, thriving PLC sector. So really it is a case of we need all of them, and it was slightly sort of tongue-in-cheek in asking people to vote for the best.